So today we look at financial statements and how principles and guidelines affect financial statements. The basic accounting principles and guidelines directly affect the way financial statements are prepared and interpreted. Let's look below at how accounting principles and guidelines influence the balance sheet, income statement, and notes to financial statements. We'll start off by looking at the balance sheet and how the basic accounting principles and guidelines affect it. We'll look at mostly Mary's Design Services, which is the sole proprietorship owned by Mary Smith. A balance sheet is a snapshot of a company's assets, liabilities, and owner's equity at one point in time. In this case, that point in time is after all the transactions through September 30th, 2013. Because of the economic entity assumption, only the assets, liabilities, and owner's equity specifically identified with Mary's Design Services are shown. The personal asset of the owner, Mary Smith, are not included on the company's balance sheet. As you can see, the assets listed on the balance sheet have a cost that can be measured, and each amount shown is the original cost of each asset. For example, let's assume that a tract of land was purchased in 1956 for $10,000. Mary's Design Services still own this land, and the land is now appraised of $250,000. The cost principle requires that the land be shown in the asset account land as its original cost of $10,000 rather than the recently appraised amount of $250,000. Next, we look at the income statement. So let's see how the basic accounting principles and guidelines might affect this. An income statement covers a period of time or time interval, such as a year, quarter, month, or 4 weeks. It is imperative to indicate the period of time in the heading of the income statement, such as for the 9 months ended September 30th, 2013. This means for the period of January 1st through September 30th, 2013. If prepared under the accrual basis of accounting, an income statement will show how profitable a company was during the stated time interval. As you can see here, revenues are the fees that were earned during the period of time shown in the heading. Recognizing revenues when they are earned instead of when the cash is actually received follows the revenue recognition principle and the matching principle. The matching principle is what steers accountants towards using the accrual basis of accounting rather than the cash basis. Small business owners should discuss these two methods with their tax advisors. Next, we look at the notes to the financial statements. So another basic accounting principle, the full disclosure principle, requires that a company's financial statements includes disclosure notes. These notes include information that help readers of the financial statements make investments and credit decisions. The notes to these financial statements are considered to be part of an integral part of the financial statements. Thank you.